In April 2024, HMRC merged the SME and RDEC schemes into a single framework. If your company has been claiming under the old SME scheme, the rate, the accounting treatment, and the cost eligibility rules have all changed. And if you have been filing the same way you did in 2022, your 2025 or 2026 claim may be wrong. In the next 7 minutes, I will show you exactly what changed in April 2024, which companies were better off before, and the one cost category that trips up most post-merger claims. By the end of this video, you will understand the merge scheme mechanics, the rate, the accounting treatment, and the net benefit in pounds. You will know whether your company sits on the standard rate or whether it may qualify for ERIS at 27%, and you will know about the overseas subcontractor rule change that is catching companies by surprise. 7 minutes. This video features an AI-generated presenter. All content is for educational purposes only and does not constitute tax or financial advice. Always consult a regulated specialist for your specific circumstances. Here is why HMRC made the change. Before April 2024, the UK had two separate R&D schemes, the SME scheme for smaller companies and RDEC, the Research and Development Expenditure Credit, for large companies and for SMEs receiving certain grants. The two-scheme system had become difficult to navigate. It created compliance complexity, particularly for companies moving between SME and large company status, or for SMEs receiving Innovate UK funding. HMRC's stated rationale was simplification and compliance improvement. From 1st April 2024, one scheme applies to all companies, the merged RDEC. The credit rate is 20%. It is an above-the-line credit, which means it appears as income in your profit and loss account before tax. For a profitable company paying corporation tax at 25%, the net benefit after the tax charge on the credit is approximately 15 pence for every pound of qualifying expenditure. That is the headline number for most finance directors preparing a 2025 or 2026 claim. For profitable SMEs, the merge scheme represents a change in net benefit compared to the old SME scheme. Before the October 2023 rate reductions, the old SME scheme produced approximately 21.5 pence per pound of qualifying expenditure for a profitable company at the 25% corporation tax rate. The merge scheme produces 15 pence per pound. That is a real difference. For a company with £500,000 of qualifying expenditure, the change is roughly £32,500 per year in reduced net benefit. The claim process and qualifying criteria are broadly the same. The rate is lower. That is the straightforward story for profitable SMEs. For loss-making companies, the transition was more complex. Under the old SME scheme, a loss-making company could surrender its enhanced loss for a payable tax credit. In some periods, that produced a cash return of up to 26 or 27 pence per pound of qualifying expenditure. The merge scheme's standard rate of 20% represents a reduction in that benefit. To compensate for this, HMRC introduced ERIS alongside the merge scheme. ERIS provides a 27% credit rate to loss-making companies where qualifying R&D expenditure represents at least 30% of total costs. For early-stage technology, life sciences, and engineering companies that are still pre-profit and spending heavily on development, ERIS may produce a net benefit comparable to the old SME payable credit. The key question is whether you cross the 30% intensity threshold. This is the change that catches the most companies by surprise. Under the old SME scheme, payments to overseas subcontractors engaged on qualifying R&D were eligible costs. Under the merge scheme, subcontractor work must be performed in the United Kingdom. The narrow exception applies only where the work cannot be performed in the UK for geographical, environmental, regulatory, or social reasons. It does not apply to standard offshore development arrangements. It does not apply simply because overseas developers are cheaper. For any company that previously claimed overseas development costs under the SME scheme, this is a mandatory reassessment. Including overseas subcontractor costs in a post-April 2024 claim that do not meet the statutory exception is one of the most common reasons current claims trigger HMRC queries. One more point that matters for many companies right now. The merge scheme applies to accounting periods beginning on or after the 1st April 2024. If your accounting year does not start on the 1st April, you may have a period that straddles the transition. A company with a 31st December year end, for example, has a period ending December 2024 where January to March 2024 follows the old rules and April to December 2024 follows the merge scheme. You cannot apply one rate to the whole year. Each portion is calculated separately using the rules that applied in that part of the period. A specialist will calculate the split precisely. Getting it wrong means either underclaiming or overclaiming, both of which create problems. So, to bring this together, from April 2024, all companies claim under the merged RDEC scheme. The net benefit for profitable companies is 15 pence per pound. For loss-making companies with 30% intensity, ERIS provides 27 pence per pound. Overseas subcontractor costs are no longer claimable under the standard merge scheme. Check your cost schedule carefully, and if your accounting year straddles April 2024, you need a split calculation for that period. If your claim has not been reviewed under the new rules, that review is overdue. If anything in this video resonated with your situation, the next step is straightforward. There is a free, no-obligation specialist assessment linked in the description below. A specialist will review your position under the merge scheme, confirm whether ERIS applies, and check your cost schedule for any overseas subcontractor exposure. It takes 5 minutes to get started. No win, no fee. The link is uplifttax.com/partners/M7X2K9. It is also pinned in the comments. If you found this useful, the video on the HMRC additional information form gives you the full compliance picture. It is on screen now. I will see you in the next one.